Ancient stock market wisdom says, don't predict markets, just buy great companies, especially undervalued ones. And ancient stock market wisdom also says that in a bear market, stocks return to their rightful owners. And in the year of our Lord, 1997, one Warren E. Buffett said, quote, before you buy a stock, ask yourself, would I be happy buying this if the market were to close for 5 years? If you say yes to that, then you, my friend, are buying a business. What's up? I'm Russ, a welder with a passion for passive income. And actually, we're looking for passive income from high quality companies, which has been one of my evolutions since I started doing this in 2018, picking or trying to pick at least individual stocks, being a little bit humbled, learning and sharing with you some of those findings. So that should go without saying. This is not financial advice because you're listening to a welder on YouTube sharing his passion with you. And part of that passion I share with you is in the form of a free weekly newsletter that you can pick up at DapperDividends.com, where I share some thoughts on investing, the portfolio moves, and dividends received, all from the week that was, where that link is in the description below. Now, before we get to the 6 dividend stocks that are undervalued, I have for you, shameless little plug here that's going to pay off, is at seekingalpha.com. You can save a bunch of money on an annual subscription with my affiliate link below. But the payoff here, and I'm going to show you one of the tools you can use, is if you hit Stock Screener on the left column, they have some pre-built screens. And one of them that's interesting is the top quant dividend stocks. That is their proprietary quant system, and what it has picked. Those would be stocks with high quant ratings for dividend safety, dividend growth, dividend yield, and dividend consistency. So if you click that, sorted by that quant rating, here you go. Some more ideas just for you. Pause the video. You want to see these closer? We got number 1, Gilead Sciences, ticker GILD, CareTrust REIT, ticker CTRE, Morgan Stanley MS, Clorox Company CLX, Vici Properties VICI, GHC Graham Holdings Company, which used to be the Washington Post, so shout out Catherine Graham, Alexander and Baldwin ALEX, Mueller Industries MLI, RTX Corporation, ticker RTX, KFY, Corn with a K, Corn Ferry, TSN Tyson Foods, Chevron Corporation CVX, Enersys ENS, the PNC Financial Services Group, ticker PNC, Philip Morris International, ticker PM, NTST NetStreet Corp, ABM Industries, and GFF Griffin Incorporated. So there you go, some bonus ideas for you, and hey, snoop around, poke around, see if they're right for you. And here we are on simplysafedividends.com, where many of you think it's prohibitively expensive. I can understand that, but you do get what you pay for. But if you want to try it out for free with just an email address, hit up simplysafedividends.com, throw an email in there, and away you go. Now, the screen I ran was for 5 metrics, and they were undervalued valuation, dividend safety score of safe and very safe, dividend yield greater than 4%, 5-year dividend growth over 5%, and a strong or very strong credit rating. Starting with the least undervalued is Prudential Financial, ticker PRU, which sells insurance policies, meaning people pay them monthly premiums for protection, and Prudential invests this money until they need to pay out claims. Now, during recessions, their investment returns typically suffer and fewer people buy new policies, which forced them to cut dividends in the last major downturn. And we see that Prudential Financial, as of this recording, is just barely undervalued. To look at this chart once we're full, you can go ahead and pause it. As well as the video here, we're going to move kind of quick to get through these. They have a dividend safety score of 75 safe, a yield currently of 5.14%, which is about in line with their 5-year average, and a strong credit rating. So Prudential's been around since 1875. They last raised that dividend, though, 3.8%, so a little bit slow, but it's been growing for 16 years, currently paying $5.40 per share per year. Now, SimpliSafe's undervaluation comes from the 5-year average price to earnings ratio, and the way that this works for SimpliSafe, this gray shaded area is 10% above and 10% below the trailing 5-year price to earnings, meaning that if it's above, it should come back down, but if we're below, it should eventually come back up into that area. So it could be a good time to buy. But as with all things, you got to really understand the business if you want to be a business owner. Don't just buy on these metrics. So this is just the beginning step of your investment journey, potentially into one of these companies, and where they expect a price of $106 to $129, and it's currently $105, and they're all the way at the low end of their 52-week price range. And again, you can always pause the video to look at these 10-year trends in a little bit better detail. The free cash flow payout ratio makes more sense for an insurer to look at their earnings payout ratio, so it's been coming down, which is good to see, as well as their earnings per share is almost at a 10-year high. Really nice sales growth, 30% last 12 months. Total sales pushing another record high, not quite yet. And shares outstanding, they're currently down to 359 million. Prudential's margins look okay. Their net debt currently at 40%, so, a little bit high, something to keep an eye on. Next up is Public Storage, ticker PSA. They own storage units that people rent monthly to store their extra belongings, and they actually tend to perform surprisingly well during recessions because as people downsize their homes, they still need somewhere to store all that stuff. Public Storage is just a shade undervalued with a safety score of 96, very safe. They have that 4.1% dividend yield, which is a little bit above their 5-year average, and they actually have not grown that dividend since May of 23, so look out, they got some raising to do. But they have paid uninterrupted dividends for 44 years, so just because they haven't raised their dividend doesn't mean that they are a weak company. They're currently paying $12 per share per year. This valuation is based on the price to adjusted funds from operations, and the way I understand it, for a REIT, this is kind of like their earnings, so it's a comparable metric to look at. Public Storage is toward the lower end of their 52-week price range, but not at the bottom of the barrel just yet. And with REITs, it's better to look at their adjusted funds from operation payout ratio, which is low. It's below 90%, so they are easily able to keep raising that dividend, which they haven't been doing. So we would need to know why they haven't been raising that dividend. Even though their adjusted funds from operations per share, their AFFO per share keeps climbing and is expected to be at all-time highs over the next 12 months. Their sales growth has come down a little bit, but their AFFO per share growth still not too shabby. Looking like it's going to be 6% the next 12 months. That's what analysts expect. And as a REIT, when you're paying out 90% of your profits to shareholders, usually you have to raise funds through debt or share offerings like they have done here, where they slowly dilute the shareholder. But quite honestly, for a REIT, only adding 2 million shares since 2015 is a drop in the bucket. So they actually don't dilute much at all. And their total sales just keep going up and to the right. Public Storage's margins are really strong, so they are one of the most well-managed public storage REITs, and that's why they get a very safe dividend safety score. And their net debt is pretty manageable at only 48% of net debt to capital, and this 2.69 net debt to EBITDA the last 12 months is how many years of their earnings before interest, taxes, depreciation, and amortization would it take if they focused and threw it all at their net debt? Would it take for them to pay off the debt? Currently 2.69 years, which is pretty low. Third, we've got Archer-Daniels-Midland, ticker ADM. They buy crops from farmers, process those into ingredients, and sell these ingredients to food companies for a higher price. ADM's business remains relatively stable during recessions since people always need to eat, which allows them to increase dividends even during economic downturns. And Archer-Daniels-Midland is even more undervalued at $47.25 as of this recording, with a dividend safety score of 70 safe. They have that strong credit rating of A, which Simply Safe Dividends uses S&P's credit rating, and as you can see, A+ to A- is investment grade, and it is a very strong credit rating. Now, ADM is a dividend king. They've been growing that dividend for 51 years. They've been around since 1902, although that last dividend raise kind of slow. So some of these companies, they may be thinking that a recession is coming. There's some nastiness coming, but anyway, dividend growth over the last 20 years, very fast at 10.5%. ADM is currently paying out $2.04 annually. Based on that 5-year price to earnings ratio trailing, they do look to be undervalued by a few bucks on the low end. But do remember they have had some accounting issues, some shenanigans going on. And one famous investor in Omaha said, usually when there's one cockroach in the kitchen, that's not the only one. As a good jumping off point for undervaluation, we like to see the dividend yield well above the historical norm and the forward PE, the price to earnings ratio, be low. Again, this doesn't tell us the value of a business or if it is really cheap, but it is a good warm and fuzzy starting point, I think. Now, their free cash flow payout ratio, 80%. I love the free cash flow to look at as a percentage of the dividend because with the free cash flow, that's where the dividend comes from. With free cash flow, you can pay a dividend, you can buy back stock, you can carry it as cash on the balance sheet. Mergers and acquisitions can be done, or reinvesting into the business are some of the main things. That's a little bit yucky there, though. From 2016 to 2020, they had negative free cash flow per share. They still managed to grow that dividend through all those years, which makes you wonder, how did they do it? Currently have negative 9% sales growth. The shares outstanding, they've been buying them back down to 493 million outstanding. Archer-Daniels-Midland's margins have been compressing, and they're nothing to write home about right now. So that's some of the reason, I think, why this stock is a little bit looking cheap. But their net debt to capital, 33%, so it's up there a little bit, but it's nothing crazy. Although the interest coverage ratio does give me pause. So remember, the interest coverage ratio is how many dollars of operating income, or EBIT, earnings before interest and taxes, does a company have to cover every $1 of interest on the debt. You want to see that a little bit higher to give them some wiggle room in case that operating income starts to take a hit. Currently, $2.85, that would make me just a little bit nervous, so tread carefully with Archer-Daniels-Midland, but one has to think that over the long run, they're probably going to be okay. Next, we got Bristol-Myers Squibb, ticker BMY. They create medicines, patent them, and sell them to patients through pharmacies and hospitals. Of course, medicine is largely recession-resistant since people can't postpone necessary treatments, and that has helped them maintain their dividend during the 07 to 09 financial crisis. There you go, Bristol-Myers Squibb even further down the undervaluation side of things. Dividend safety score of 70 safe. They also have that A strong credit rating, but their dividend growth too has been slowing. The last 20-year CAGR, though, 3.9%. The last 5 years has been a little bit quicker. They've grown that dividend for 18 years, and it's been uninterrupted for 54 years. Bristol-Myers Squibb paying out annually $2.48. Looking pretty undervalued. Not as much as they were earlier in 2024, but at the current price of $60.28, they expect a price of $69.84. That dividend yield has come back down a little bit. It was a lot higher, and they are actually toward the upper end of their 52-week price range. BMY's free cash flow payout ratio, 32%. That's nice and low. Free cash flow per share at all-time highs. Sales growth, 7%. Not too shabby. Shares outstanding down to 2.03 billion. Total sales again at all-time highs. The free cash flow margin looks very nice. Operating margin still 20%. Could be a little higher, but that's not too bad. This would be the bugaboo. Net debt to capital, 71%. That is way the heck up there, although the net debt to EBITDA has been coming down, so they should be able to service that debt, and they have $5.02 of operating income to cover every $1 of interest on the debt currently. Next, we'll go shopping at Target, ticker TGT. They buy products in bulk from manufacturers and sell them to consumers at a markup in their retail stores. That's how Target works. While they maintained and even increased dividends during the last recession, remember their sales can shift toward lower margin essentials as consumers cut back on discretionary purchases. And the thing about Target, they don't have as many essentials and non-discretionary items like Walmart or Costco does, but they do have a dividend safety score of 80 safe, and at the current price of $104, they're well below that expected price range of $140 to $171. So let's peep in on Target, ticker TGT. They get a dividend safety score of 80 safe, A, strong credit rating, and them too have grown that dividend a little bit slow, 1.8% in June of 2024. Like ADM, they were established in 1902 as well. Target is a dividend king with 53 years of dividend growth streak, so shout out Target. And right now it looks like they're just kind of treading water, and they are slowly increasing that dividend to make their streak. I think hoping for better days ahead, but check out that 20-year CAGR for Target, 14.2%. My. Target's hitting you with $4.48 of dividends per share every year. That current price, again, of $104.50 as of this recording is well below the expected price of $140 to $171. So could be a very good time to get into Target, and they are almost to the COVID lows of 2020. They're at a 52-week low, and that dividend yield of 4.29% is sky high above the 5-year average of 2.61, and a forward price to earnings of only 11.4. Remember, that means you're paying $11.40 for every $1 of Target's earnings. Free cash flow payout ratio only 46%, but analysts think their free cash flow per share is going to take a hit over the next 12 months, which would push it up to 73%. It hasn't been that high in the last 10 years, but they did have negative free cash flow per share in 2023. Remember, they were burning off all kinds of inventory that they overstocked from the supply chain issues that were going on. And they've had negative sales growth the last couple years, which their total sales looks to be stalling out after it hit a high of $109 billion in 2023. But they do have 462 million shares outstanding, which it looks like they've kind of slowed down repurchasing their shares lately. Now, their margins look okay. Return on equity, 29%. Remember, that can be skewed by debt. Free cash flow margin, 4%. A little bit low. We'd like to see that higher, hopefully in 2021, where they were doing, everyone was shopping at Target. It was 8%, but we'd like to see it back there right around 6%. But their net debt doesn't look to be a problem. This is one of the things that I think is a strong point for them, is their balance sheet is not horrible, despite what some people say. It would take them 1.65 years of EBITDA to wipe out the debt. Their net debt only 51%, and interest coverage, dude, $13.54 of operating income for every $1 of interest on the debt. They can easily pay that. And last, we have a company you may not be familiar with, which is Magna, ticker MGA. Magna manufactures car parts and sells them to automobile companies that use them to build new vehicles. But they are highly vulnerable to recessions because consumers delay purchasing those new vehicles during economic downturns, and that led to a significant dividend cut in the last recession. And I think the market is pricing that in with Magna because they are $35 currently, with the lower end expected to be $54 of that price range. Liquid hot Magna has a dividend yield of 5.47%, which is towering, as you'll see, above the 5-year average. A-, a strong credit rating, and they are a Canadian company, so dividend taxation may be withheld. Yeah, their recession return was negative 77%, while the S&P 500 was negative 55%. The recession sales negative 35%, and that did lead them to cut the dividend during the recession. But even though Magna cut the dividend, they cut it to zero, but then look at the thing, it just shot up like a rocket ship. So 8.6% 20-year CAGR, but only a 2.1% raise in February of 2025. Annual payout of $1.94 for Magna every year. And based off their trailing 5-year dividend yield is how they're undervaluing this one. They give a price of $54 to $66. They expect it to be. Current price is $35.48 as of this recording, so it's way the heck way down there. There you see again, the 5-year dividend yield average is 3.24%. They're at 5.47, so they're way, way above that. And a PE ratio of only 7. As a dividend investor, I get really nervous when I see a free cash flow payout ratio over 100%. That's no bueno, and that's not sustainable for the long run. Maybe a year, couple years, companies can get through that, which it looks like they did. They were down to 38%, but analysts expect a little bit of a hit to the free cash flow, and that they'll be up to 52% free cash flow payout ratio, but still nothing too crazy. 0% sales growth. And yeah, the big one, the black swan year of 2020, they were negative 17%. They've also kind of hit pause on the share buybacks, down to 287 million shares outstanding. That's not a lot of shares outstanding. Total sales still going up. Gently, not stair-stepping like a Visa, but currently at $42.8 billion. Most of their margins have either been staying flat or compressing, so that's something we have to watch out for. You always want to look at what's been happening. Again, it's not indicative of the future, but it can give us clues, right? The past performance. And that free cash flow margin, only 3%. That means when you see this number, 3 cents of every dollar in sales and revenue coming into the business is making its way to free cash flow. So you want to see that just a little bit higher. Magna doesn't look like they have much of a debt problem. Now that interest coverage ratio has been stair-stepping the wrong direction since 2015, currently down to $6.85 of interest coverage ratio. And yeah, as soon as that number goes negative, you got problems and it could be game over, and it's time to take drastic measures like cutting the dividend and doing whatever you can. So I don't know how their debt situation looks, if they have floating rate debt or a lot of fixed debt, or when some of those covenants are coming due. But as with always, debt has to be paid back at some point. So we'd like to see higher interest coverage ratios and lower debt. But I don't think Magna's in any kind of danger zone just yet from what I see. I hope you enjoyed this tiptoe through the dividend stocks that potentially are undervalued according to Simply Safe Dividends. And I'd love it in the comments below if you would share your favorite undervalued dividend stock from this list. Are you buying any of these? I think Target looks interesting, but is it because I see Target everywhere? Let us know, or what is in general your favorite undervalued stock that you think is a great one to buy right now. And also in this floating little box, I'm buying more Realty Income, ticker O, and I shared 5 fantastic thoughts that Sumit Roy, their CEO, just said at a few investor conferences and their earnings call. So if you're an investor in Realty Income, click that floating little box and I'll tell you all about it there.